This is Scott Becker with the Becker Private Equity and Business Podcast. We try to come to you daily with short business episodes, short private equity episodes, interviews with brilliant private equity and business leaders, trying to make sure you're learning something, we're learning something. We're here today with Matt Wolf of RSM. He's going to talk about what he's seeing in the private equity world today. We're post-election. Matt, take it away. Tell us about what you're seeing.
Yeah, I'm seeing a lot of very wild takes across the economic spectrum on what the new administration could mean for growth, for the global economy, for M&A, for all of those things. And, I think it's interesting to read, but at this point, there's a lot of dust that has to settle yet before we worry too much about that. I think in the sort of here and now, what we're seeing is deal activity is still high, right? Sponsors, organizations are still looking to get deals done, particularly done by the end of the year. There's some changes to the, HSR, Hart-Scott-Rodino compliance regulations that are going into effect in January. So, there's kind of this typical dash to close deals by the end of the year. The interest rate environment is more accommodative than it was 6 months ago. We'll get another rate cut here today, and it's all conducive to a healthy deal environment. But we're still, and I don't expect that we will see, but we're still seeing like a high level of diligence and thoughtfulness being put into these transactions. I don't see that necessarily easing in the future, even as rates come down. I think sponsors, organizations are still going to take very thorough looks at these deals, even if they do try to close them, quickly by the end of the year or to beat out a competitor or something. So we're still going to live in this world of a higher diligence, careful looks at everything. But again, a much more accommodative deal making environment than it was 6 months ago. 6 months from now, we'll see what has changed, if anything. But in the here and now, most people are kind of firing on all cylinders, Scott.
It seems like all of a sudden everything is firing on all cylinders. For a little bit, it was just the huge firms, the Blackstones, the Apollos, the TPG, who are all knocking out of the park, as well as KKR. Now it seems like the small, the mid-sized fund are all getting into the game. I am still hearing that fundraising is going a little tougher than it used to go. Any thoughts there or any sense of what you're hearing there?
Yeah, that's a really good point. And the fundraising environment tends to lag the deal making environment by some period of time, right? Depending on who you talk to, whatever you read, it could be 6 months, it could be 2 years. So we expect that to remain competitive and difficult for some time. Not only are institutional investors dealing with a denominator effect and potentially over allocated into private equity, but private credit has become much more attractive as an alternative asset class. And, returns have been squeezed, right, as we transition from free money or near free money into this sort of real interest rate environment. So it's a really good point and we expect that the fundraising environment will continue to be difficult, really in the near to perhaps medium term, but it will look very different, right? For various factors, right? Number one, the size of the fund. If you and I could start a private equity fund, Scott, which actually would be really fun, maybe we should, but we would have a much harder time raising money.
What happens is when people raise funds, start funds the first time, unless they're highly connected, they're doing a lot of non-institutional funding of their first fund. And at the end of the day, it is just very hard to get scale that way until you've got some track record, or if you start off just being one of these hyper-connected people, and you see some of those that do that, they've had such great experience at other funds that they were running that they're able to run funds. But when people are raising funds, I see people raise first funds, less than $100 million with lots of friends, family, angel investors, et cetera, et cetera. And that is a brutal game to gain scale on. And then you see people sort of graduate to the next level where they start to be institutional investors. And that seems to be the holy grail of getting to be a serious fund. So when you start to get to serious institutional investors.
Absolutely. But I think too, and we've talked about this before, that where smaller funds will have an advantage go in this new environment is if you have a hyper focus, right? And if you have some very strong operating partners that know an industry very well and can leverage operational efficiencies into an investment thesis to drive outsized returns by leveraging experience, acumen, insight, all those sorts of things that other sponsors, other even strategics might not be able to bring to that specific space. But I think that can be competitive. It will take time to prove out those returns. Like you said, you're still going to have to go on that journey from sort of friends and family to bigger and bigger bigger and bigger LPs. But I do think that in this new environment where operational efficiencies means a lot and multiple arbitrage, financial arbitrage means less, if you're a sponsor that can demonstrate significant ability to drive operational efficiency in one or more market niches and subsectors, that will be a huge advantage in fundraising.
Right. And fundraising will get easier once we start to see people having FOMO, meaning once people are getting distributions or they see their friends getting distributions from other funds, they will be much more apt to want to invest and not miss out on the next winning fund. I mean, all it takes is a handful of distributions for people to, again, especially the less sophisticated investors, high net worth individuals, even very affluent high net worth individuals are much more, I think, emotional about it, and they start to see distributions. They don't want to miss out on their buddy who got a 3 times return there, and they want to make sure they get into the fund. And the institutional investors are probably much more disciplined about it. But now with the market so high, there was a period of time when the market had fallen and people were over allocating in private equity. Now, from an institutional perspective, because the stock market is so high, there may be a lot of funds that are again under allocated in private equity and have a mandate to put more money into private equity again. That's probably coming pretty soon if the market keeps on going up.
Well, and that's the question I'm curious about, and we've begun to see some, research from the institutional investors or research arms, but as those large institutional investors look at their allocations and say, wow, we can put some more money into private asset classes for exactly the reason you mentioned. I wonder, if 5 years ago, if they would have put 100% of that excess, let's call it, into private equity, going forward, will they? Right? If they say, hey, we can allocate $500 million more into private assets, are they going to put it all into private equity, or are they going to split that between private equity, private credit, other sort of funding or financing mechanisms? I think to a large degree that remains to be seen and will be worth watching.
Well, and real estate funds as well, but yes, into private stuff, not just public stuff. But it'll be interesting to see what the mix becomes because people like CalPERS had gone up to 15, 16% mix. They had been over allocated for a period of time to private equity when the general market was down. Now that the market's up so much, I wonder if they're under allocated and got to relook at putting money away into private assets. But you're right, credit and equities as well as other alternative assets.
Yeah, maybe not Bitcoin, but some other assets, right?
I tell you, Bitcoin, I was one of those that got out of it too early, it appears. It is what it is. Anyways, Matt, it's great to visit with Matt Wolf, leader at RSM, one of the best firms in the business. Matthew Wolf, thank you for joining us on the Becker Private Equity and Business Podcast.
Thank you, sir.